Welcome to another video. In an ever-evolving economic landscape, the quest for generating passive income has become increasingly important for investors seeking financial stability and growth. As we step into 2024, various investment avenues offer promising returns with minimal active involvement. This video explores the 7 best investments for passive income in 2024, analyzing their potential benefits and risks. Let's get started with the video. 7 best investments for passive income in 2024. Dividend stocks, a time-tested strategy. Dividend stocks remain a cornerstone in the realm of passive income investments. Companies that pay regular dividends are often well-established and financially stable, making them a lower-risk option for income-seeking investors. The key to success in dividend investing is selecting companies with a strong track record of dividend growth and sustainability. In addition, investors should look for companies that have a history of weathering economic downturns and maintain a healthy payout ratio, which indicates a balance between dividends paid and earnings retained for growth. It's also important to diversify across different sectors to mitigate risks associated with specific industries. Moreover, the advent of fractional shares and online brokerages has made dividend investing more accessible than ever, allowing investors to build a diversified portfolio with smaller amounts of capital. This democratization of investment opportunities means that dividend stocks are not only a proven strategy for seasoned investors, but also a viable option for those new to the investment world in 2024. Real estate investment trusts, REITs, accessibility to property markets. Real estate investment trusts, REITs, have revolutionized the way individuals can participate in the property market. By investing in REITs, one can gain exposure to a diversified portfolio of real estate assets without the need for direct ownership or the complexities of property management. This investment vehicle pools funds from multiple investors to purchase, manage, and finance real estate properties, ranging from office buildings and apartments to healthcare facilities and warehouses. What sets REITs apart is their requirement to distribute a majority of their taxable income to shareholders, often resulting in attractive dividend yields. This feature makes REITs a favored choice for income-seeking investors. Moreover, the liquidity of REITs being traded on major stock exchanges provides the convenience of buying and selling shares like stocks, a significant advantage over traditional real estate investments, which are typically illiquid. Peer-to-peer, P2P. Lending, embracing the digital age. Peer-to-peer, P2P lending has revolutionized the way individuals invest and borrow money, harnessing the power of technology to connect lenders directly with borrowers. In this digital age, P2P platforms offer a seamless, efficient, and often more accessible alternative to traditional banking systems. By facilitating loans for a variety of purposes, from personal loans to small business financing, these platforms provide investors with the opportunity to diversify their portfolio across different loan types and risk categories. One of the most appealing aspects of P2P lending is the potential for higher returns compared to conventional savings accounts or fixed deposits. As investors fund parts of or entire loans, they earn interest as borrowers repay the loan, creating a steady flow of income. Furthermore, many platforms offer automated investing tools, allowing investors to set their investment criteria and have the platform automatically allocate funds, further simplifying the investment process. High-yield savings accounts and CDs, the safe haven. For those seeking a more conservative approach, high-yield savings accounts and certificates of deposit, CDs, offer a secure way to generate passive income. While the returns might not be as high as other options, they provide stability and federal insurance protection. In 2024, as the financial markets continue to navigate uncertainty, the appeal of these safer instruments is particularly strong for risk-averse investors. High-yield savings accounts are especially attractive due to their liquidity and ease of access, allowing investors to withdraw funds without significant penalties. These accounts typically offer higher interest rates than traditional savings accounts, making them a practical choice for short-term savings goals or as an emergency fund. Certificates of deposit, CDs, on the other hand, lock in funds for a predetermined period, often yielding higher interest rates in return for the commitment. By laddering CDs, investors can benefit from higher rates while still having access to portions of their funds at regular intervals. This strategy is particularly effective in a rising interest rate environment, as it allows investors to take advantage of higher rates as older CDs mature. Bond ladders, diversifying interest rate risks. Bond ladders involve purchasing several bonds with varying maturity dates, creating a portfolio that can adapt to changing interest rates. This strategy is particularly effective in managing interest rate risks, as the staggered maturities provide regular income and opportunities to reinvest at potentially higher rates. By diversifying across different types of bonds, such as government, municipal, or corporate bonds, investors can also spread their credit risk. In 2024, as economies continue to navigate uncertain financial waters, bond ladders offer a blend of safety, income, and flexibility. This approach suits conservative investors looking to balance their portfolio against market volatility, while ensuring a consistent income stream. Furthermore, bond ladders can be customized according to individual investment horizons and income needs, making them a versatile tool in any investor's arsenal. Index funds, the set-and-forget approach. Index funds have become a staple for investors looking for a low-maintenance, set-and-forget approach to growing their wealth. These funds are designed to track the performance of a specific market index, such as the S&P 500 or the NASDAQ. The primary advantage of index funds is their ability to offer broad market exposure, thereby diversifying investment risks across a wide range of assets. Additionally, they are known for their lower expense ratios compared to actively managed funds, making them a cost-effective choice for long-term investment. In 2024, the appeal of index funds continues to rise as they provide a balanced blend of reliability, simplicity, and performance. This investment strategy is particularly appealing to those who may not have the time or expertise to analyze individual stocks, or to constantly monitor market fluctuations. Furthermore, the historical performance of index funds has shown them to be a formidable competitor to more actively managed portfolios, often outperforming them over extended periods. Rental properties, the tangible asset. Owning rental properties stands out as a particularly tangible and often lucrative source of passive income. This investment strategy involves purchasing properties to rent out, thus generating a consistent stream of rental income. While it requires an initial capital outlay and ongoing management, the rewards can be substantial. Rental properties not only provide monthly cash flow, but also offer the potential for capital appreciation over time as property values increase. Additionally, rental properties can serve as a hedge against inflation. As living costs rise, so typically do rental prices, which can lead to increased income for property owners. This aspect makes rental property investment particularly appealing in an economy experiencing inflationary trends. Investors can also benefit from various tax deductions associated with property ownership, such as mortgage interest, property tax, operating expenses, and depreciation. These tax advantages can significantly enhance the overall return on investment. For more videos, like and subscribe to our channel. Thanks for watching the video.